Bank of America published a research note 2 months ago that most of the financial media either ignored or dismissed. Their head of metals research, Michael Widmer, one of the most senior commodities analysts at one of the largest banks on earth, put a number on silver that made people laugh: $309 per ounce. Not as a hypothetical, not as a joke. As the upper range of a formal research projection for 2026. The note was published when gold was trading near $5,000 and silver was around $81.50. Most people saw the number, assumed it was clickbait from a bank trying to generate headlines, and moved on. Then gold hit $5,400 today. And the math behind that $309 number did not get weaker. It got stronger. Because the entire framework of Bank of America's projection is built on one number, the gold to silver ratio. And that ratio just got blown wide open by the largest single-week move in gold since 2020. So in this video, I'm going to do something that I have not seen a single analyst or channel do yet. I am going to take Bank of America's own methodology, plug in today's gold price, and show you what the updated numbers actually are. And I need to warn you, the updated number is not 309. It is higher, significantly higher. And the reason it is higher is the same reason that most people still have not figured out what is happening in this market. Before we get into the math, let me give you today's numbers so you understand the context. Gold opened on COMEX this morning and surged to $5,400 per ounce. That is up over 2.5% from Friday's close, and it is a new all-time high. Silver gapped up at the open and hit an intraday high of 96.93. Brent crude surged 14%. WTI surged 12%. The war between the United States, Israel, and Iran is entering its third day. Over 1,000 targets have been struck inside Iran. The Strait of Hormuz remains disrupted, and the market just told you in real time how it feels about all of that. Now let me show you what Bank of America actually said and what it means at today's prices. The gold to silver ratio is the single most important number in precious metals that most people never look at. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is approximately 56 to 1. Gold at 5,400, silver at 97. 56 ounces of silver to buy 1 ounce of gold. That sounds like a fixed relationship, but it is not. It moves. And when it moves violently. In 2011, at the peak of the last major precious metals bull market, the ratio dropped to 32 to 1. Silver nearly tripled in 18 months, while gold gained about 80%. In 1980, during the Hunt brothers squeeze, the ratio dropped to 14 to 1. Silver went from $6 to $50 in less than a year. Those are not random numbers. They are the two historical extremes that Bank of America used to build their forecast. And here's the math. At the time of the note, gold was near 5,000. 32 to 1 ratio gives you $135 silver. 14 to 1 ratio gives you $309 silver. That was the range, 135 to 309. Now update the gold price to today's 5,400. 32 to 1 gives you $168.75. 14 to 1 gives you $385.71. The range is no longer 135 to 309. The range is 168 to 385. And if gold continues to climb, which every major bank now expects under continued war conditions, the numbers get even more extreme. At $6,000 gold, which both Bank of America and JP Morgan have flagged as possible, 32 to 1 gives you 187. 14 to 1 gives you $428 per ounce of silver. Now I want to be completely clear about something. These are not predictions. They are mathematical scenarios based on historical ratio compression. The ratio may not go to 32, it may not go to 14. But the point is that the ratio has gone there before, under conditions that are less extreme than what we are living through right now. The 2011 compression happened during European debt crisis concerns and quantitative easing. The 1980 compression happened during the Iran hostage crisis and stagflation. What we have right now in 2026 is a shooting war with Iran, a closed strait, 3 dead American soldiers, central bank gold buying at record levels, 5 consecutive years of silver, structural deficit, and the largest physical delivery demand in COMEX history. The conditions for ratio compression are not similar to previous episodes. They are more severe. If this is the first time you're hearing Bank of America, is ratio analysis connected to what is happening right now that tells you something important about who is giving you your information. Hit subscribe. This channel does this work every day. Understanding that the ratio can compress is one thing. Understanding why it compresses is where the real insight lives. And this is the part that most channels never explain because it requires you to think about silver differently than gold. Gold moves first in every crisis. It is the default safe haven. Central banks buy it. Sovereign wealth funds buy it. When a war starts, the first $1 trillion of fear goes into gold. That is what happened this weekend. Gold went from 52.78 to 5,400 in a single session. But here's what happens next. Gold gets expensive. Not just expensive in absolute terms, but expensive relative to the amount of capital trying to get into the precious metals space. When gold is at $5,400 an ounce, a $100,000 allocation buys you about 18.5 ounces. When silver is at $97, the same $100,000 buys you over 1,000 ounces. The math pushes capital down the periodic table. Not because silver is better than gold, because the same fear, the same desire for hard asset protection finds more volume, more exposure, and more upside potential in silver at these relative prices. This is not theory. You can see it happening in real time. COMEX registered, silver dropped 64% from 240 million ounces to 86 million. January deliveries were 7.2 times higher than the same month last year. February set an all-time record. March has 52 million ounces standing for delivery against a vault that has 86 million total. The metal is physically leaving, not rolling from registered to eligible, leaving the vault entirely. People are not trading silver, they are taking it. And when people take physical metal out of the exchange at this pace, the system that relies on paper contracts being settled in paper starts to break. That is the mechanism behind Bank of America's $309 call. Not that silver will go up, because people are excited. That the physical market will overwhelm the paper market, the same way it did in 1980, and the ratio will compress because there is not enough silver available at current prices to satisfy the demand. The war just accelerated this timeline by months. Shanghai premium is 20% above COMEX. London lease rates have spiked. Insurance companies have canceled marine coverage through the Gulf. Industrial users who depend on silver for electronics, solar panels, and medical devices are front-loading orders because they cannot risk supply disruption. Every one of these dynamics pulls physical silver out of the available pool and pushes the ratio lower. Here's the part of this story that I have not seen on any other channel, any news outlet, or any analyst report. Bank of America published their forecast when the conditions for ratio compression were theoretical. The supply deficit existed, but it was manageable. The delivery pace was elevated, but the vault was not in crisis. The geopolitical environment was tense, but there was no shooting war. Every single variable that Widmer flagged as necessary for the ratio to compress toward the extreme case has materialized in the last 72 hours. Let me read you the conditions. Bank of America said would need to happen for the 309 target: a liquidity event, a delivery squeeze, a surge in physical demand that overwhelms paper markets, a liquidity event. Gold went vertical by over $120 in a single session. That is a liquidity event, a delivery squeeze. COMEX has 86 million registered ounces against 127 million demanded in 60 days, with 52 million standing right now for March. That is a delivery squeeze, a surge in physical demand that overwhelms paper markets. Shanghai premium at 20%, London lease rates at 39%, industrial buyers front-loading, investment demand projected to rise 20% to 227 million ounces, a 3-year high. That is physical demand overwhelming paper. Every box is checked. And the number is no longer 309, because gold is no longer 5,000. Gold is 5,400 and climbing. The target has moved to 385 under the extreme scenario and 168 under the conservative scenario. And I want to emphasize the conservative scenario. 168 means silver nearly doubles from here. That is not the extreme case. That is the base case if the ratio compresses to where it went in 2011 during a much less severe crisis. The cumulative silver deficit since 2021 is now 820 million ounces. That is an entire year of global mining output that has been consumed and not replaced. Fresnillo, the world's largest primary silver producer, just cut their 2026 production guidance from 45 to 51 million ounces, down to 42 to 46.5 million. Supply is shrinking at the exact moment demand is exploding. The math does not care about your opinion. It does not care about mine. It just runs. And right now it is running toward triple digits as a floor, not a ceiling. So let me tell you where this leaves us on Monday evening, March 2nd, 2026. Gold is at 5,400 and still being bid. Silver touched 97 this morning. Oil is up double digits. The war is expanding, not contracting. Israel struck Lebanon today after Hezbollah fired missiles at an Israeli defense site. 31 Lebanese citizens were killed. Ben Gurion Airport is closed. The United States Embassy in Jerusalem is closed. The United States Embassy in Bahrain is closed. Trump said the operation could take 4 weeks or less, which means the market is pricing in at minimum a month of elevated war premium. Bank of America said the ratio could compress to 32. It said it could compress to 14. They published that forecast before a war, before gold hit 5,400, before COMEX registered silver fell to 86 million ounces, and before every condition they flagged as necessary for the extreme scenario materialized in a single weekend. The updated math gives you 168 on the conservative end and 385 on the extreme end. And the question you have to ask yourself is not whether silver gets there. The The question is, what would need to happen for the ratio to not compress? Gold would need to stop rising. The war would need to end immediately. COMEX would need to source tens of millions of new ounces. Industrial demand would need to collapse. None of those things appear to be happening. Gold is accelerating. The war is expanding. The vault is draining. And demand is growing. I'm going to leave you with one number, 820 million ounces. That is the cumulative deficit since 2021. 5 years of consuming more silver than the world produces. You cannot run a deficit forever. At some point, the price adjusts to balance supply and demand. Bank of America says that adjustment takes silver between 168 and 385. The only question is timing. And the war just moved the clock forward. I do not give financial advice. I do not tell you to buy or sell. What I do is show you the data, the math, and the framework so you can make your own decisions from a position of knowledge instead of ignorance. If that is valuable to you, subscribe. If it is not, I hope this video gave you something worth thinking about. The market is open, the ratio is moving, and the math is the math.